So the question is, if simple is better, would no indicators at all be best? Now, for me, the short answer to that is no. Now, there is a saying that I use, and I put it in every one of my manuals just about, and that's make a thing as simple as possible, but not simpler. And when it comes to trading, there's a lot of people currently trying to trade with no indicators. And a lot of the people here have come from that sort of trading, and it's destroying their accounts because they are simply not getting enough information from the charts. When you have no indicators on your charts at all, there's not a lot of information that people can extract from it. Now, some traders don't have too much trouble with it, but most traders cannot do it. I don't want to do it myself. So let's go to a blank chart. Now, this one has no indicators at all. So if we're looking at this for buy, sell opportunities, we want to know a few different things. We want to know if the market is in a good place to buy or sell. We want to know what direction the market is most likely to go. So we want to know if we're buying or selling. But when you're looking at a naked chart like this, there just usually isn't enough information. When I add just a couple of different indicators, I can get the information that I'm looking for. I don't need a ton of indicators to do this. If I go to the Ultra Blue template, there's a lot of different indicators in here. They're not all necessary. We've got the RSI, we've got the QTI, we've got the switch down here, and we've got these little switch arrows on the chart. Now, we don't need all of those in order to have a simple system. These are confirmation tools. These give us additional entry signals if we are not currently in a trade. So let's reduce some of this. And this down here is simply a market hours indicator. We don't need that one either. So let's just get rid of that. Let's get rid of this switch trend, and we'll get rid of the dots. Now, the dots are a nice filter. They give us nice signals, but we don't really need them. All right, so with this, we've got a system that is much simpler. And I'm going to make this even simpler yet. So let's just get rid of this. Let's start with a blank chart. And now with this blank chart, again, signals or information isn't coming to us quite as nicely or clearly. Whether we buy or sell, that's a tough decision to make if you are not an expert at this. You have to be doing this for a long time in order to make sense of a chart with no indicators. So the first thing I'm going to do is add a moving average. Now, when I talk about indicators, I'm almost always talking about moving averages. I trade with moving averages. I won't trade without them. So this first moving average, let's make this one a 55. So this is going to be a 55 exponential moving average. So the style is fine. We'll go 55 and we'll hit OK. And with this 55 EMA, what we're seeing is when the price is above the EMA, the market tends to want to go up. And when the price gets to that EMA, it looks as though it could potentially bounce. So right here, we get an area where it bounces off the EMA. Here, we get an area where it bounces off the EMA. And we get a pullback close to that 55, and it bounces off that EMA. So when the price is above the 55, we'd be looking for buy opportunities. I get an idea of a few different things here. I get an idea of a market that is trending, so I know what direction I want to trade. I get an idea of where the price is suitable for looking for a trade. When the price gets into this 55, I know that this is a great area to start looking for buy opportunities. And I know when the price gets away from the 55 that the market is considered overextended and buy opportunities may not be ideal. So we get a market that is overextended, get a market that is overextended. We get a market down here that's far from the 55, it's overextended. Again, it's overextended. Here we get it coming back into the 55, and then it becomes overextended. So with this one moving average, I get an awful lot of information. I know what direction I'm looking to trade. I know where the setups or the sweet spots potentially are when it gets back to the 55. I know when the market's overextended. When I'm trading with a blank chart, I don't get that kind of information, not in the same way. Now let's add a second one, a second moving average. Now with this second moving average, we'll make this one a 21. Turn it red so it looks different. And with these two moving averages together, I have to think even less. With the 21 over the 55, I have an uptrend. I can see that just by looking at these two moving averages. When we have the 21 below the 55, we've got a downtrend. So with a downtrend, I'm looking to sell. With a uptrend, I'm looking to buy. With these moving averages, this 21 also gives me the same kind of indications. The price gets to the 21 and then it moves away from the 21. We get overbought and then we get a sweet spot. Get overbought and then a sweet spot. We get that in both directions. Let's look for a market moving down. We get a market that's oversold and then we get it into the sweet spot. So we're looking at these two moving averages, giving us a lot of ideas what to do as far as the market goes. When we don't have any indicators on the chart, we don't get the same kind of overview. I don't like to trade without at least one moving average on the chart. This moving average gives me a really nice idea of what the market is doing. Now, it's been said that moving averages lag, and they lag because they're supposed to lag. It's literally in the name of the moving average. It's an average. It averages out X amount of candles. In this case, it averages out 21 candles. In the blue case, it averages out 55 candles. Now, whether these are simple or exponential doesn't make a huge difference. You're going to get the same kind of information. So let's make this one an SMA. We'll make the 55 an SMA as well. So now we have these moving averages as simple moving averages, and we get the same kind of information. Now, I prefer the EMAs for the most part because we don't get a lot of this crisscross, not in the same way that the SMAs do, but the information is there, the same kind of information. We get a market that pulls away and then comes back in to those SMAs. And the same thing with this. We get the market that pulls back into it and then away, and then back into it and then away. And these would be opportunities for us to either buy or sell. In this market move up, we see these beautiful opportunities all along the way. We don't get these same kind of opportunities or the same look when we have no indicators on the chart. From here, it's very clear where the areas to buy are. Now, if I get rid of these, we don't get that same kind of information anymore. That information as to this being a nice spot to buy, this being a nice spot to buy, this being a nice spot to buy, and so on, isn't quite as clear to us. And we don't have an idea of when the market could potentially move, when it's going sideways, when it's flattening out, when you have two moving averages that are smooshed together, they start moving sideways. So let's throw those back on the chart. And then from here, we have all the information that we need. We've got flat sideways market. Moving averages are coming together. We've got a flat sideways market as the moving averages are together. We get a nice separation between the price and the moving averages. We've got a good momentum to the upside. Moving averages are coming together. This is a moving average squeeze, and a moving average squeeze is a really nice opportunity for a trade. When the moving averages squeeze, you get the price in between those moving averages. They squeeze and then the price pops out into the trending direction. We get a beautiful opportunity right there. And then the price continues to move and then moving averages separate and then they squeeze again. And then you get a nice opportunity once again. Now these moving averages provide a lot of information without a lot of noise. They're not giving us an overwhelming amount of information. They give us one set of information that does not conflict. We get a trend, we get a pullback, we get the trade. And using a moving average, we could even get signals. We get zone trades when the price gets into the space between these moving averages and closes back outside. That's considered a zone trade. We have elimination trades that we can use. We have price action trades like engulfing candles and so on at these areas. When the price gets to these areas, they become critical as far as looking for price action. You could be looking at integrating patterns. You could be looking at chart formations, support resistance areas. If you're looking at this here, we've got an area of a support and resistance line. This is a resistance level. Price gets above that resistance level, off it goes. It's getting squeezed in here. It's almost like a formation. We get this squeeze. But if I'm looking at taking a trade that is going to cross an area of support and resistance or a trend line, I want to be taking that trade in the direction of the trend. We see that in here as well. We can draw a trend line across the top. Once we get that pop out above the top of this trend line, the market continues to move up. Now, this is a very powerful way to keep things very simple, very clear, and very profitable. So if you're struggling with naked charts and you're struggling with all the lingo that is happening with naked charts, add a couple moving averages, take a look at that. Use that same type of analysis. Market moves away and then comes back into it. Moves away and then comes back into it. When the price comes back into a set of moving averages that is trending, you are looking for an opportunity to take a trade in that trending direction.